Good morning, everyone, and happy Wednesday. Thank you so much for joining our webinar today. My name is Brianna Mosier with the Flint and Genesee Chamber. Today, I am joined by my colleague, Tyler Rossmessler, the Director of Economic Development, and our speaker, Paul Traub from the Federal Reserve Bank of Chicago. Before I hand it over to Tyler, a few housekeeping items that I would like to address. This presentation is being recorded, and it will be available on our website, Facebook, and YouTube pages. We will be using the comment section to add remarks and ask questions, so please feel free to do so at any time. We will have plenty of time to address these once Paul has concluded his presentation. A big thank you to our webinar series sponsor, Blue Cross Blue Shield and Blue Care Network of Michigan, for their continued support. Our goal with this webinar series has always been to provide you, our community partners, with the most up-to-date information. The global pandemic has had far-reaching consequences, and as our CEO, Tim Herman, mentioned in his blog today, the economic distress that Flint and Genesee County businesses are experiencing as they reopen or not is something that has been really top of mind to us all. So given this, the Chamber staff has been working very diligently on providing support and resources to help make this time less challenging. So with that, I will go ahead and hand it over to Tyler to introduce our speaker.
Thanks, Bree. Thank you, everyone, for joining. I think today you're going to find this presentation very engaging and informative. Paul Traub is a senior business economist at the Federal Reserve Bank of Chicago, which is our regional bank, Federal Reserve Bank here in Michigan. And he has spent 25 years in the auto industry prior to joining the Fed, working for Chrysler. So he has a good understanding of what the economy is like here in Michigan and the nation. So with that, we're going to kick it over to Paul. Paul, thank you for being here, and the floor is yours.
All right. Well, thank you so much. I'm assuming everyone hears me fine. It's the first time I've done it on this platform, so we'll move fast. So I want to thank you for letting me join and talk about the economy. I'm going to talk a bit about the C plus I plus G, I always call it consumption, investment, net exports, government spending. That's the overall U.S. economy. We'll touch briefly on the consumer, the auto industry. And I'll be making some remarks, as you can see on my first slide, that may not necessarily reflect all the views of the Federal Reserve Bank of Chicago or the FOMC or any of the bank presidents or chair of the bank. The Federal Reserve is an institution that employs an army of economists, and I'm just one of those. And it's probably one of the best places I've ever worked for knowledge and growing your understanding of the economy and where you work and live. So on my first slide, is kind of an overview. You can see we'll talk about the economy. So I'm going to talk about real GDP. As I mentioned before, it fell 31.7% coming into the pandemic. That's in the second quarter numbers. Really a decline in personal consumption, business investment, which experienced historic declines not seen before. It was a pretty sharp decline. And everyone talks about, how quickly will the rebound, and we'll touch on not only where we've been, but where we think we are now, and then where we're going from this point forward. One way to look at the economy, since it's highly tilted towards consumption, is University of Michigan Index of Consumer Sentiment. The attitudes of the consumer drive a lot of what's going on in the economy. They remained relatively unchanged in July. The preliminary number for September is out. It was 78, slightly higher. We will see that on the chart. But again, the consumer attitudes fell pretty drastically too as the pandemic hit. Business and fixed investment declined 28.9% in the second quarter, with non-residential investment falling 26%, and residential investment declining 37.9%. And these are on seasonally adjusted annual rate basis. So that's a pretty significant decline on the business fixed investment side. The trade deficit actually fell, but that's because imports fell more than exports. But overall, the total trade was falling, and it was 1.1 trillion on a SAR basis. Congressional Budget Office also has recently reported as a percent of GDP. The U.S. budget deficit has reached levels not seen since World War II, and it's continuing to grow. And we'll touch on that because I think that's an area that's not getting enough attention. Non-farm payroll labor added 1.371 million jobs in August. So you hear about, oh, this is great, we've added jobs, but added is probably the wrong verb. We brought back jobs because so many jobs were lost. Some 20 million people were on layoff or temporary layoffs on the onset of the pandemic. And employment is still down over 11 million jobs since its peak in February. And I touch on inflation because if you understand how the Fed works, we use monetary policy to promote the economy, to promote full employment, while at the same time managing inflation. So inflation is important to the Fed because it can hinder us on what we can do. We don't want to create inflation. So if we are too accommodative in our stance, we can create inflation. So as long as the inflation is below our target or below some range that we think is reasonable, that gives us the ability to move in any direction we want and use all the tools available in our toolkit. On the next slide, we'll show you that precipitous drop. So you've got three recessions there. You've got the 2001 recession. You can see it's barely a recession at all. The Great Recession in 07, which we thought we would never repeat. I spoke in a lot of groups, and I've always said that we'd never see another recession like that in our lifetime. And lo and behold, here we've got one of the greatest drops in the history of the country, 37.1%. So you can see the red bars are percent change on a seasonally adjusted basis, and the black line is where we are. So $17.3 trillion from over 19 trillion prior to the recession. And the next slide, I break this down into the C plus I plus G components as they contribute to the overall economy. And I wanted to look back in time because I want to point one thing out here. Consumption has become such a large part of our economy. You can see back in the 50s and 60s when I was young, it was almost 2/3, but about closer to 60% of the economy. Now it's closer to 70% of the overall economy. We are a consumption-based economy. I like to bring up the old the old cereal commercial. The guy Mikey, he would eat anything, and that's Americans. We pretty much consume anything from anywhere around the world that we can get our hands on. And so private investment has been growing, but you can see that's replacing investment in government consumption and investment. So this is the privatization of a lot of things that at one time early on, back in post-World War, were considered government responsibilities. And we're seeing that with, charter schools, other types of areas where you're starting to see this privatization of public goods. And so you can see the private investment growing, but the net exports continue to be a big headwind to the overall economic growth. Back in the 50s, it barely took not even a full percent out of GDP. So you add all three together, and if net exports is negative, it's a negative addition, so it takes away. But you can see with all the work that's been done to try to change that, we can see with tariffs and all that, it really hasn't changed much. When you look at the second quarter, still took out 4.4% of the GDP. Next slide then breaks this C plus I plus G into their contributions for the particular quarters. And you can see your 37.1% drop. The numbers on the bottom should add up. So 24%, 24.8 was negative contribution from consumption, almost 9% from investment. Net exports, as I said, was positive, and government did have some positive contribution as the government continues to grow and spend money. Next slide. So the sentiment number that I pointed out jumped up to 78.9 on the preliminary. I didn't mention that on the front slide because this is still preliminary and could change. But if this holds, this shows that the consumer is somewhat more optimistic. But you can see where the optimism at levels that we haven't seen since the 2010-11, when we were still trying to recover from the Great Recession. The next slide talks towards what drives. So when you look at consumers' attitudes, there's kind of two ways to look at it. It's do I have money to spend, and am I confident in spending it? So when you look at consumption, it's an ability and willingness. And one of the ability side is, how's my disposable income doing? And so this slide is similar to a lot of slides that I'll be showing you. There's these large shifts. So you look at real disposable income. It grew in because of the payroll protection, the extra $600 for Social Security, a lot of stimulus that was added to the economy. It had peaked at over almost 16%, about 16% 2 months ago. And as of July, it was still up 8.4%. You can compare that to the long pattern of around 4 to 3% growth in real disposable income. 3.5% is kind of a target. You look at growth in income and wages. So you can see that this is the money that was thrown into stimulus, and this is going to have a big impact in the recovery that's going to show up or is being projected for the next quarter, because people had a tremendous amount of money to spend. And I compared that to what happened to real wages and salary distributions. As you can see, they fell precipitously also. So this was all this money, or most of this growth was not growth in wages or salaries. It was growth in stimulus money that was added to the economy, a kind of a one-time shot in the arm. Next slide. When a lot of people did with it right away is save it. You know, you get this extra windfall of cash. So what do? You put it in the bank. And also in these difficult times, people tend to save more money. So you can see what's going on with the savings rate as it's actually jumped up. But there was still such a large jump in income that it helped support this kind of savings rate. On the next slide, you'll see credit growth. And what I show here is I show non-revolving and revolving credit. So this is your credit card, revolving credit, auto loans kind of stuff. And you can see as a percentage of real disposable income, it fell. And it fell because real disposable income grew so much with that one-time shot in the arm. But you can see that it has been rising pretty steadily. And if you go back into the 60s, 70s, 80s, you can see that it averaged around 17% of total real disposable income, or actually disposable income, not adjusted for inflation. And then you compare it to what had happened in the late 90s, that interest rates started to get lower, or more activity in the finance markets. You can see that it jumped up. And this was a big concern, is how much debt can households carry? And it was starting to climb and still climb as we led into this recession, as the economy heated up and people were spending money that they necessarily didn't have, not unlike the federal government. Next slide. So what really happened, although as a percentage of disposable income it fell, you can see how much total consumer credit grew. In April, it was up 17%. And even in July, it was still up on a year-over-year basis, 23.2%. So consumers are spending a lot on credit. Now, talking to people, we collect a lot of anecdotal data. People were using credit cards to pay normal bills, pay their gas bill, whatever they could do on credit. And then when you get all this big shot in your arm, people feel rich, they're spending money. So this is a concern, because you're starting to see people becoming more and more in debt. I think this is part of the issue of, do we need another stimulus package to keep people from going so far in debt as they go further and further into the slower economic environment. The next slide then shows, shows interest payments. And again, the Fed has stepped in. We've lowered interest rates immediately. Back in March, we started lowering interest rates, taking the federal funds rate to almost zero. The cost of borrowing fell. So you can see, as a percentage of disposable income, it fell. But also, you got to remember, not only
Paul, it sounds like we lost your audio real quick. So let's maybe have you unplug and replug.
How's that?
Headphones. Perfect.
All right, sorry. I'm sorry about that, technical issues. But when you look at what interest payments actually did go up about 6%, but when you compare it to the way we always try to, I don't want to say seasonalize, but you try to compare it to some baseline, you can see that because income went up, interest payments as a percentage of that income fell. But in the next slide, we'll see that on the next slide, there we go. You can see that people spent more money, and they spent a lot of money on credit cards, and they spent money as this income came into the economy, people spent it. A lot of people went out. Retail sales jumped. You can see they jumped way up in those first 2 months of the economy. Some of that you could argue is pent-up demand because it was falling pretty precipitously during it. So people postponed some purchases, but all of a sudden they had liquidity. People started to go back to work. They made up for it. But you can see now on a month-over-month basis that that stimulus has somewhat worn off in this. So it's going to bode very well for the second quarter. But you can see as you start to get into the third and fourth quarter, that's waned, and that's why there's so much discussion about, do we need more stimulus? The next slide shows you what U.S. auto sales did. So you can see the pandemic hit. We were averaging close to 16.2, kind of the number we thought was what we were going to end up at, closer to 17 million, fell to 11.4, then 8.7. And has marched back and now is sitting about 15.2 million units in the most recent numbers. So the auto industry, which Michigan is highly dependent on, was able to come back. However, in the next slide, you'll see that a lot of that was supported by huge incentive spends. You can see that as a percentage of transaction price, we were spending money that we hadn't spent before on incentives to bring people into the showrooms. And that was back in April when there was still only 8 million or 9 million sales. But as we start to see this come back, we're starting to see that incentive money start to go off. And that's for a couple of reasons. The next slide will point to that. We can see that prices are starting to rise. Auto vehicle transaction prices, and what I've shown here is comparing them to overall CPI all items. So you can see CPI all items in August was up 1.3%. Actually, that I think is July, 1.3%. But in August, auto prices in July were up 6.1%. And that has a lot to do with the mix. So everybody keeps talking about light trucks and SUVs and the importance of them to the auto industry. And you can see that their prices, when you look at their share, they're up to 76.5% of the industry compared to where they were in 07, which was closer to 60% of the total industry. And I did a little deep dive study, and the average light truck, so if you take an SUV, mid-size SUV, and you compare it to a mid-size sedan, they run anywhere from 50 to 60 to 70% more depending on the size and the content of the vehicle. So on average, light trucks cost more money. So what we're seeing is prices rise because of the mix of the fleet. We're selling more and more expensive cars. And so the concern is, will you sell less because you're going to higher price, less quantity? The auto companies like it because you make more margin. So the margins are greater on those vehicles. So that's why they migrate to those vehicles. Why sell small compact cars that have no margin, require just as much investment in technology and in machinery. So they're moving towards these vehicles with higher margin. The only problem I see with that again is you might start pricing some families out of that new car market, which is helping the used car market. So if you look at used car sales last month, there were 40 million used cars sold as people are being priced out of the newer cars and go towards the used cars. Next slide. Next slide shows production. You can see the production fell to just about nothing. As we move forward, you can see it starting to come back. And right now in August, we were producing pretty close to what we did last year. Again, that's a different mix though. So a lot of automobile manufacturers are producing heavily in the SUV pickup truck side, and they're not producing so much on the lower vehicle side. But that's good. Michigan's doing well because Michigan does well when the auto company does well. So Michigan's recovery usually mirrors the recovery of the auto industry. On the next slide, you can see, though, what's happening to inventory. So when you look at inventory sales, when I showed you that 15.4 sales number, and you compare that to amount of inventory, you got to say inventory to sales ratio that's at low levels we haven't seen in over a decade. So automobile companies are trying to make product, but their inventories are very low. So I think going forward, one of the challenges they're going to have is getting enough product that's affordable into the showrooms for people to go if we want to see auto sales continue to grow or get back to where they were. So on the next slide, you can see that the projection now for the year is about 14 million. We had a couple of strong months But still the year to date, we only average at about 13.6. So that means we'd have to do a couple 15s. Might be running out of inventory. And then we don't know what's going to be happening with incomes, whether there's going to be another stimulus. So there's so many unknowns that I think the auto industry is probably going to see a couple down years. Not that 15.7 is a horrible year. My estimates, trend would be about 16.5, so it's not that far off of trend, but it's going to probably take a while for this to come back for the auto industry, for Michigan to get fully running again until we get a vaccine and everybody back to work. Next slide. So on the private investment side, there's your 8.7% I pointed out earlier. You can see non-residential. Residential was down 1.72 versus 3.48 or 3.5 for non-residential. Inventory change. Again, you can't produce things, so you use out of inventory. So inventory fell pretty radically, so that's your total drop in 8.7%. The next slide. And as we look at that, one way to kind of gauge investment, private domestic investment is manufacturing. So you look at the ISM Manufacturing Index, and again, this can be somewhat misleading. I'm going to start to sound like a broken record, but you can see that it's very positive. But this is based on a diffusion index. So diffusion index takes percent changes period over period, month over month, and so when you go down so sharply. The recovery looks a lot stronger than it might be when you look at the Purchasing Manager Index above 50, 56.8 for composite, 56 for manufacturing. Shows a strong manufacturing recovery, but again, you're coming from such a low trough that can be somewhat misleading. Although it's positive for the economy, it may not be as strong as those numbers would suggest. Next slide. Because if you look at total industrial production, you can see that it is up just 0.4%. It was a big jump in percent change on a month-over-month basis as you bring people back. But as we start to go through these few months, you're starting to see it level off at a lower growth rate. I think this is pretty much we're going to see with the overall economy as we go forward. We're going to see this big jump, and then this kind of leveling off as we get back to what the new normal is and what the playing field is. So you can see now you're only 1.4% industrial production above what it was in 2012, and well below where the 110 or so that we were experiencing coming into the pandemic. Next slide. Housing starts was somewhat surprising, although the last month we did see somewhat of a downturn, 5.5%. But the housing market has been fairly strong. A huge drop. We were doing quite well in the winter months because it was a little warmer winter, so builders were able to build. But you're starting to see that kind of again pattern out. Come down, but 1.4, almost 1.5 million housing starts is a pretty strong market. That's what most analysts would say would be kind of a normal market. But again, some of that is pent up demand, and we'll see how it plays out as we go forward and deeper into the year. Next slide. And existing home sales also were 6 million, very strong as people looking for homes. We had a huge drop again, and again, pent up demand as people postponed those purchases, and they started to jump. On the next slide, you can see one of the reasons why home prices homes are selling so well is mortgage rates are like at historic lows. You can see you can get a 30-year fix for under 3%. And 10-year fix for 2.6%. Even adjustable rate mortgages, which are slightly higher. But again, very, very strong mortgage market that's supporting these housing sales. Next slide. On the trade side, I like to look at total trade. So I talked in the opening slide about adding the imports and exports together to get the negative. But this is total trade. So if I add the two together and do a % change on total trade, so this is the amount of trade coming in and going out of our ports. So it reflects better on what the world looks like. And you can see that it was down 58, almost 60% in total trade. So things shut down in the second quarter in trade. It wasn't only the U.S. not exporting; we weren't importing. So total trade. So that was a big hit to the global economy as well as our economy. Next slide. But we are collecting a lot of money. So this is the tariff. So the tariffs are adding custom and duty. So $81.6 billion in tariffs is the estimate that we're going to collect in 2020 right now, based on the Bureau of Fiscal Services. And I don't care what anybody says, someone pays that. You could say it's paid by the other country, but actually somebody's got to pay it. Usually ends up being paid by the consumer at some point. So I would call that somewhat of a headwind also in consumption, as you'll see prices rising for certain items because of the duties. Next slide. So at a point in time when the economy was growing for its 10th consecutive year, we had reached a point in time where the economy had grown for 10 years, the longest economic expansion in the history of the U.S. We found it necessary to do another tax cut. And so you can see what's happening to the tax cut. So you can see that these are what I would call average tax rates. So I take corporate profits before and after taxes and calculate what their tax rate was. I take personal income versus disposable personal income, which has the taxes taken out of it, and you can see where their tax rates are. So individual tax rates didn't fall much at all, but you can see corporate tax rates went from 20% down to 13%. So they had a pretty precipitous fall. The green dotted line is corporate dividends as a percent of profits. So a lot of people say, well, we cut corporate tax rates so we'll get more investment. I just want to say that this doesn't prove it definitively, but you can see that most often when taxes are cut, dividends go up. So most often that money goes out as income to stockholders of the company. So again, it's kind of a regressive tax cut in that those that can afford to own stocks. Now, some people do have pension plans and other things of that nature would benefit from that. But you can see that the money wasn't necessarily rolled back into the companies for more investment in equipment or personnel. Next slide. And so you can see what happened to the deficit. So here's federal receipts and expenditures. So here in the middle of a pandemic, you're going to spend a lot of money, which we did, and receipts fell pretty precipitously. Down overall receipts were down 5.1. The deficit fell another. This is like $5 trillion in an annualized basis deficit. So it's a huge change as receipts fell and spending went up. On the next slide, you'll see kind of what the projections are from the Congressional Budget Office, which follows this out to 2030 for another 10 years. So you can see as deficits are projected to rise from 4.6% in 2020 to 5.4% in 2030. So you can see in 2020 to 5.4% in 2030. So they will exceed their 50-year average throughout that period of time. So if we continue on the next slide, what if we follow this path, where we'll end up with projected deficit? By 2050, we could see the deficit close to 200% of GDP. Deutsche Bank did an analysis of this, and they announced that that's my dog, Freddie. He doesn't like it when I'm talking. So their projection is if interest rates were to rise by 1%, that projection by 2050 would be 300% of GDP. I mean, these are territories we've never seen. So you compare this to World War II or the Civil War, even World War I, you'll see that we are currently near where we were at World War II. And we are headed into territory unprecedented. And the problem with that is you have to sell these securities. And so one of the issues is that with this debt is there's an inverse relationship between the price of a security and the interest rate you charge. So if you're selling $40 trillion worth of treasuries into the market, you're going to have a substitution effect. There's going to be people buying those instead of other securities. So there's this investment trade-off that people will be making. And if you're going to sell that many, are you going to have to lower the price? And by lowering the price to sell them, that raises the interest rate. So they projected again that if interest rates even go up 1%, this deficit could rise to 300% of GDP in the next 30 years. Next slide. So when I mentioned earlier, we use Monetary policy to support the economy to create full employment. You can see the employment levels prior to the recession were at record lows, or not record, but we had reached that before, but 3.5%, way up, still sits about 8.4. One of the reasons it's only 8.4, as you look at the next slide, you can see participation rate fell. So rather than staying in the labor force, if I leave the labor force, then my unemployment rate falls. So you can see payroll jobs fell, 140,000 working right now, participants fall. Next slide. And where did they lose them? Well, we're still down 11.6 million jobs overall. Leisure and hospitality is down 25% almost. You can see that mining is down 11%. Information down. You can see every area of the economy is down in some faction of another in jobs and as a percentage of where they were at their peak. Next slide. And some of these jobs were temporary jobs. You can see temporary job losses were 18 million. But there were also some 3 million in permanent job losses that may not come back. And one of the big things that we're learning about now is living post-pandemic. What will the world look like? How will jobs be? Working from home? What impact's that going to have on office rents? What impact's that going to have on businesses? Are we going to be doing more of this kind of work going forward? So that remains to be seen as it plays out. Next slide. And you can see the unemployment claims still pretty close to 860,000. So they seem to have leveled off somewhere between the 8 and 900,000, where there's still almost 13 million people on continued unemployment claims. So each month we're still seeing close to 900,000 people filing for unemployment. Next slide. Hourly earnings jumped. Again, this is kind of just like vehicle prices I've talked about earlier, it's a mix issue. So what's the first thing that went out of? If you talk about a lot of businesses when they have their back to work plan, it's essential services only. So when you look at the kinds of jobs that were lost, I'm not saying they're not essential, but they were, a lot of them were lower paying jobs, as you saw earlier. Hospitality, restaurants closed, wait staff don't make a lot of wages, they make their money in tips. So that balance, when you start to take a weighted average of those, you can see that it shows a big jump in wages, but the reality is wages didn't go up that much. Next slide. That's shown here what percent total non-farm went up 5.6, but when you break it down into these areas, what kind of job wage growth they got wasn't anywhere near that. Financial got pretty good, did pretty well. But overall, that's a mixed issue, not as much an issue of wages actually rising. Next slide. On the inflation side, we still are, again, below 2% on both CPI and personal consumption expenditures. We like to use core personal consumption expenditures because that adjusts for substitution, where CPI is a fixed basket of goods. Core CPI uses what was actually bought. So if I don't like steak because it's too expensive, I can buy fish or chicken. And so that's where that inflation number allows for that adjustment. It allows for changes in availability and price. Next slide. And inflation expectations still remain below 2. So again, as I pointed out earlier, this gives us our full basket of tools that we want to use for the Fed to help continue to support the economy, because expectations continue to remain low. When you look at the Treasury inflation protected securities, which has a built-in inflation component, you can see that it remains below 2%. Next slide. And we don't see oil going up. You know, the last few big spikes in inflation that we saw in the 70s and 80s was large spikes in oil prices. This used to be always good. The low oil price was always good for the auto company, always good for selling vehicles, especially gas guzzling sedans. However, now it's not as good for the U.S. because you saw that huge drop in mining jobs because we now produce more fossil fuel than any country on the planet, oil through fracking and natural gas. And this kind of price restricts that exploration and recovery of those products, and that's why you saw such a big hit to the mining and exploration. Until those prices go up, I wouldn't expect to see that going, those jobs coming back completely anytime soon. Next slide. And so I wanted to show here monetary base and bank credit. So I hear a lot of questions a lot of times about, well, the Federal Reserve just prints money. Well, we don't print money. We create liquidity. And we do that through our actions, buying securities. We own a lot of mortgage-backed securities that were on the bank books. By doing that, we give them access to capital, which they can lend. You can see what we did in the Great Recession and the year subsequent to that, where the reserve bank credit is kind of close to the bank balance sheet. There's more in there where you got gold and other kinds of securities, but that's kind of close to what the bank balance sheet looks like. We were starting to come back down as we were coming out of this recession and rebalancing the balance sheet. We weren't probably going to go back down to 1 trillion, probably somewhere 2.5, 3 trillion, 3.5 trillion with numbers that I heard bantered about. And then the pandemic hit, and we pulled off all the stops in making sure that the credit is flowing and there's cash available in the vaults of banks everywhere. So if you go in and you need money, you have it. That's the worst thing. One thing you don't want to have is a run on banks. So we've done everything we can to make liquidity out there in the system, and that shows up in that monetary base number. Next slide. One of the things we tried to do also with our work is take the volatility out of the stock market. You can see how volatile the market got early on in March, and as the market started to collapse and the stock market fell. Nobody likes a lot of volatility. Most people don't like a lot of volatility. Chaos is not necessarily a good thing. When you're a finance guy or you're running a business, you want to know what your stock price is going to be, and you want to know what cost of products is going to be. You want to know things pretty much for a long period of time. That's why a long and stable inflation is so good. I want to be able to plan for next year. What is my price of my input goods going to be? What's the price of my labor going to be? What am I going to have to do going forward? And volatility is bad. So one of the things with all the work we've been doing is to try to stabilize the volatility in the stock market. Next slide. But you can see the composite for the has done quite well. We hear all the time now about how well the stock market's doing. However, when you look at the PE ratio, price to earnings, it followed the stock market right up. So it wasn't that earnings were expected to rise; it was just stock prices were expected to rise as more people got into the market, and we've done a lot to help that by stabilizing the market and providing liquidity out there. So you can see that the market is back, but it's still kind of where we were when we entered into the year, but we at least brought it back to that point in time. And I give the Fed a lot of credit for the work that they've done to help stabilize these markets. Next slide. Big thing is the yield curve. So what's the cost of money? As you know, you borrow short, lend long. And so you can see this is the only index that is predictive. Whenever the yield curve has inverted, we've 9 out of 10 times you've had a recession within 12 to 14 months. And again, it worked. However, for a different reason, as you can see, the yield curve had inverted and the economy was starting to slow down. And some of the slides, if you saw that there was, and I didn't point out, I should have spent more time pointing out, is the economy was starting to slow down as we started to come into this, but it was still growing at over 2%. It actually was growing at or near its potential. It doesn't necessarily need a stimulus, but you don't want to oversell. You don't want to buy from tomorrow. You don't want to be selling tomorrow's purchases. You don't want to have people overstock their shelves. You only need so many rolls of toilet paper. You only need so many automobiles in your driveway. And there's cyclical pattern to that, and you allow that to warm up and cool down, and you manage that in a controlled way. It's the business cycle. And we were starting to see the business cycle. But now with what we've done in the markets by lowering rates, we've created a little more liquidity. There's 58 basis points, almost 60 basis points of spread. So you can borrow money short, lend long, and there's money to be made for the banks to lend. So you want to make that spread financially viable for banks to want to lend money. Next slide. So we have a financial index, financial conditions index, and that you can see the higher it is, the tighter. We've been able to bring that down. Next slide. Activity index, again, bounce back, and our index shows a big bounce back, but now starting to recede back towards the long run trend. So this index, whenever it's at 0, you're growing at trend. And so 0 is not bad. Negative means slightly below trend. Real negative probably means negative growth. Next slide. And so here's the forecast. So here's your 37.1 drop, and we'll probably see on all the projections I've seen a big jump. So you're going to see 24% growth, and it's going to be probably promoted as the greatest economy ever. However, you're still going to be on the next slide. You'll see you're still going to be a long way from getting back to where you were. Even if you follow those numbers that I showed you, and there is not another disruption, we don't even get back to where we were, where we left off before the end of 2021. So when people talk about this being a quick recovery, yeah, for 80% of it, but the rest is going to have to chug along as we come out of this recession. Next slide. And the globe is going to do the same thing. So you can see if advanced economies fell 8, back 4.8. So you're not even halfway there. And that's 4.8% of a lot lower number. You look at the world is going to fall 4.9, bounce back 5.9. So the world will probably get back closer to parity by the end of 2021. But again, it's going to be slow, not only here, but around the world. Next slide. And when we look at Michigan, we have an index for the Midwest Economic Index that we use. Again, standard deviations from trend. Zero value means you're growing the overall region. That's the district bank region. So this includes Iowa and Illinois and Indiana and Wisconsin and Michigan. You can see that it fell and it's starting to bounce back. Next slide. And if I pull just Michigan out of that index, you kind of see the same thing. Although Michigan did a pretty precipitous drop, we're starting to come back. But again, even though we're bouncing back, we're a long ways from being back to what we would call a long-term trend. Next slide. And the big issue is what happens with COVID. So as you can see the slide with COVID, you can see that we had started to bring the cases down, but then summer, we opened up economies. We started vacationing. People started to get more lax. We were starting to 70, 80,000 peak kind of cases a day. We're down now trailing around 40,000 cases a day with over 200,000 people that have died so far in the virus. So I just don't think this is going away anytime soon. And I'm concerned that if we don't pay attention to this, you could see these projections for the next few months maybe somewhat overly optimistic if we don't get this under control. Next slide. So the U.S. economy suffered unprecedented decline since its start. Labor markets are showing signs of improvement, but remained extremely stressed. Federal Reserve has taken extreme actions, and I showed you what we did to the monetary base to try to create liquidity in the system to promote maximum employment. Estimates from the blue chips say we will not get back to our previous peak until after 2021. And while the number of COVID cases look to have leveled off, they remain twice the levels that we were able to achieve in June, with some states are starting to see, and I don't know if you saw the map today, significant rises. Dark red states, they're seeing significant rises again as we go back to school and start opening up businesses. We're starting to see more and more cases. That's what I have, and hopefully I didn't use up all the time, and there's some time for Q&A.
Thanks, Paul. That was really amazing thing. I can't believe you can go 43 minutes without one note. I mean, I didn't see you referencing any notes, but that was an unbelievable.
No. Nothing up my sleeve.
Yeah, it's perfect.
It also sounded like your parrots or the birds that you have at your house were very well versed in the economic impact as well.
Yeah. My bird follows this very closely. In fact, tells me every day what I miss.
I do have a couple questions for you in just a few minutes left. I guess the first thing that I'm interested in is you reference, I know you are at the Chicago Fed and you're focused on the Midwest and you talked about Michigan, but do you have any reference about what other states, how they've responded? Is anyone responding better or worse? How are we doing comparative to our other regions and other states around the country?
Well, compared to the region as a whole, we're probably following very closely to the region, and we have an index that's called the relative index to what we're doing to the nation, and we're tracking. Michigan's doing very well tracked to the nation. One of the big things with Michigan is it lives and dies with the auto industry. As much as we'd like to say we're a lot more diverse, and we are getting better at that. Michigan really does still live and die with the auto industry, and the auto industry sprung back pretty heavily. My big concern, and other states, every states are trying to open up. And I think what we're seeing with that opening up is more and more cases and more deaths. So now it's going to start to be a trade-off. At what point in time is it just too painful to open the economy? How many deaths are important? This idea that it would have been maybe 2 million deaths if we hadn't done what we did. I still think 200,000 is too many. In relative to the rest of the nation, I think everybody's kind of tracking the same in that trying to do what they can to stimulate their economy. Different economies are based on agriculture. So Iowa's doing well as soybean prices have shot up. But when you look at those that are manufacturing, they're struggling not only to keep people working, but to keep the amount of cases down in their facilities. A lot of PPE requirements, so there's extra cost. I hear a lot of businesses talking about having to pay slightly higher wages to get people to come in, and even places like grocery stores that have very low wages are giving retention bonuses to employees. So I think going through this, we're doing as well as anyone can be expected, and I don't think anybody's doing as well as they would like to be.
I was struck by probably 9 out of every 10 of your slides basically had a pattern, and then something shot up or shot down spring of 2020. So it kind of is nerve-wracking. But then you got into the projections, where projections basically say, and then things get back to normal in a longer term. If that is the case, and if things get back to normal, barring any second wave of the virus or anything like that, just if things do get back to normal per your projections, what will we have learned through all of this? Say, I think the last time we had a major pandemic like this was 102 years ago. So what if one comes back in 50 years? Or what if one comes back in 75 years? Or what if one comes back in 5 or 10 years? What will we have learned from this pandemic, from economic recovery perspective?
Well, I think we've learned a lot. It's what we're willing to retain of that knowledge, I think, is going to be the challenge. I think what this shows me is how fragile the economy is, and how fragile our workforce is, and of course this year and this election year and the divisions that are being magnified really point to different perspectives. So I think it really points to there's a lot of work to be done to shore up even some of these what one would call unessential. I made a comment one time that we lost all of our unessential jobs, and I got a lot of pushback, and rightfully so. Just because I work at a Burger King doesn't mean I'm not an essential worker, right? And you're right, but I don't think those types of service jobs were intended to be careers. So in my mind, and whether or not we're willing to accept this, I think we've learned that we're not investing enough in not only physical capital, but in human capital, so that people are prepared and have the skills to provide something that's of value to society and value to the economy, even in hard times. I'm very fortunate. And you look like you're working, and we're not missing a beat. I mean, I'm got my suit on, and I'm sitting at my table in the kitchen, and I'm very fortunate. But there's a lot of people that don't have that ability. So I think the thing that to me it pointed out is we can't spend money from tomorrow, which is what the fiscal debt is doing, and put ourselves in a position where we're not able then to respond to a pandemic, or not able to respond to a crisis. Everybody needs to have some kind of cushion, and I think even not only do corporations, but countries and households need to. And I think we've learned from this lesson that we just aren't prepared for some kind of a quote unquote pandemic or major catastrophe.
Mm-hmm. Mm-hmm. That's good. I don't know how to end it on a better note. How do I end it on an upbeat note? That's so true, though. I mean, and it's interesting to say that, preparing the nation for the next catastrophe also needs to make sure that our households are prepared, right? So
correct.
If we have so much debt or whatever. I mean,
you're right. If you got to go out and throw $600 billion into the economy just to get by for a quarter, then there's a problem in my mind. We're throwing trillions of dollars out into the economy just to keep things afloat. Once that money's gone, it's gone. And we need to do a better job of making sure that we don't get in a position where we have to do something like that, that we have some. I mean, it was an interesting statistic that, most households, majority of households, can't afford a $400 or $500 emergency expense without dipping into savings or dipping into some kind of credit. And those credit charges I showed you are, I think, good examples of that. A lot of people had to move to their credit cards just to make insurance payments or house payments or car payments, those types of things.
Well, this is great. This is very, very informative. Thank you for your time.
Yeah, real quick before we wrap up, we did have one question come through on Facebook. So transitioning away from households to small businesses, what single piece of advice do you have for small businesses going into 2021?
Boy, I would say keep your powder dry. I mean, that's one of the things if you look at what we did as a nation, I don't want to point to that tax cut as a major malady, but we basically we had $1 trillion, we were going into $1 trillion worth of debt going into the economy. And then all of a sudden you got to throw another $5 trillion at it or $6 trillion at it. You're just not in a position. I know small businesses are in a really difficult position because, again, if you don't have revenue, what position do where can you go from there? But I think you really have to make sure that you don't overextend yourself. You don't get yourself in a position where you have too much debt, and you have a fallout plan. Start to look at, what kinds of maladies. The next one may not be a pandemic. Maybe it's just a normal recession. But you want to start looking towards what kind of contingency plans do I have in place if I want to stay viable going forward? What's my balance sheet look like? What are my normal costs? You got to do your budgets. A lot of small businesses that I talk to, business leaders, people with great ideas don't have any finance background, or they don't understand accounting. So those are the areas I think that even a small business owner that can make the best pie or makes the best, cupcakes, also needs to make sure that they understand how businesses work, what their balance sheet is, what their expenses are, and don't get yourself into a position where you're so indebted to stay in business that you can't handle some kind of slowdown.
Great.
Okay.
All right.
Thank you for that. We will.
All right.
I think it's hard, like Tyler said, to end on a positive note, but we can end on a hopeful note that things will eventually steady out. It's going to be a long road, as we saw across many, many of your slides, but with the hard work of everyone involved, we'll definitely get there. Before we wrap up today, I do want to give another thank you to our webinar series sponsors, and then a couple of other important sponsors here at the Chamber, the Flint and Genesee Chamber Luncheon sponsors that you're seeing on the screen here. Thank you guys so much for joining us today. Thank you, Paul, for all of your great insight, and we will see you next time.
All right. Thank you so much. Have a good day.